Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On tonight's program, I'm talking to Junbei Liu of Tribeca Alpha Plus and getting her reaction to the big, scary sell-off last week. Was it something that created a fear factor for her or a buying opportunity? I think if you know Junbei Liu, the words buying opportunity is more likely. Then we talked to Jason Tay, who's the fund manager of Vertium Asset Management, which nowadays manages the Switzer Dividend Growth Fund. And I want to see how an income fund manager like Jason reacted to last week's events and what stocks he thinks look like value, given the fact that there was a bit of a sell-off over the last week or two. So that's the show. Let's kick off now with Junbei Liu of Tribeca Alpha Plus. Thanks for joining us, Junbei Liu.
Thank you for having me, as always, Peter.
I'm wondering, were you scared last week? It's a silly question of me asking you this, but there were a lot of investors worried about last week, you know, when there is this rotation going on. Anyway, then throw recession into the mix and the market seemed to overreact desperately, particularly in Japan.
That's right.
All right. So what's your reflection on last week's activity in the market?
Absolutely. You know, that question, you're right, because I was excited
Yeah.
on the day the market fall like that. Look, my reflection is that, quite frankly, investors didn't quite expect the interest rate cut probability in the US can be so soon. And because the data has turned a little bit worse than expected, then the you know, expectations for the rate cut, for 50 basis point rate cut in September, and then markets start worrying, what if they don't do that? Then suddenly it's recession and, you know, all hell. But for investors coming from Australia as well, I actually think this bodes really well for us. First of all, the rate cut now is very firmly in place in September for the US.
Yep.
And I think the likelihood is for 50 basis point
Really?
cuts.
Yeah.
And I think if it does really happen, it's good for Australia because that really puts RBA in a very tough position and to cut the rate and not cut rate until next year.
Yeah.
So I do think that will pull forward the rate cut for Australia in for RBA.
Yeah. And ultimately, both you and I think that once the market believes we're close to a rate cut, that's going to be good for all those interest rate sensitive companies that copped it in 22, 23.
That's right. And then small cap companies. So companies, any company that's been impacted by high interest rates, whether it's with their valuation or, you know, it's the debt and everything else. So I do think these ones you want to pay, you know, clearly pay attention to. Last week, another example, last week when Monday we had the sell-off, you know, because people worry about recession, they were selling all the retailers here in Australia. And today we just had the good result coming from JB Hi-Fi, share up close to, you know, 10%. So it just goes to show that these are your opportunities. So picking up some of those cyclical companies who's more sensitive to a rate cut when it does come.
Yeah. So in many ways, when you said you were excited, you saw it as a buying opportunity for you because you've got a collection of companies that you think are going to do well in the next 6 to 12 months. And if you can buy them cheaper, happy days.
Yeah, it's like an en masse sale. You know, always those days where we pick up all the stocks.
And you do like going shopping, don't you?
I do, absolutely.
But of course, there's the important proviso that both you and I are right that the US probably isn't heading for a worrying recession.
No.
I think slow down or possibly a technical recession, but to me the signs aren't that bad. So was the one jobs report that got people jumping unbelievable in many ways?
That's right, it is. And then to be honest, the job report was only just a little bit softer, not that much worse, a little bit softer, and gave the investor the opportunity saying, oh, you know what, we're going to take profit off the table, take money off the table, and then we just want to be sure and to see what happens. I think, you know, with the sudden change in the investors' appetite, it really forces central banks' hands, you know, really telling them, look, you've got to cut interest rates. So, and then this really removes the risk of them saying, oh, we're going to wait till see how it goes.
Yeah, because they do have a history, central banks, of loosening too late as well as tightening too late.
That's
we saw that with Dr. Phil Lowe's
That's right, yeah.
mistakes.
Yeah.
And I guess you understand why the Reserve Bank Governor Michelle Bullock doesn't want to go too early. But the same point, Jerome Powell has been given a pretty powerful lesson that if he holds on too long, the US could end up in some kind of serious downturn.
That's right. And, and then what we have learned from those central bankers in the last 10 years is that, yes, they may react slow, whether up and down, but they do listen to the financial markets. So especially when financial markets putting, sudden changes and tightening financial condition, because when share market falls like that, creates panic across a lot of confidence across a lot of asset class, it certainly tightens the financial condition. So it actually sends a signal to the Fed that they need to do this, otherwise the recession will be ahead, and they will listen.
That's the big picture. Let's go into the small picture, various companies. Now, I'm quite happy for you to say, Peter, you're absolutely wrong. I do not agree with you. But it seems to me in the US, there is a rotation out of the big tech companies that have done unbelievably well, probably too well. Nvidia's a case in point, unbelievably well. And it seems to me that some fund managers must be taking a bit of profit, not dumping them totally, and then looking at the companies that are going to do well as interest rates fall. Is that a fair observation?
Absolutely. You look at Nvidia, even though it fell to 30% from the peak, but it still doubled from January. So people just taking some profit off into a company that's being, trading very cheap valuation, and it will do better relatively.
Because in a sense, they're new age blue chip companies, aren't they? And so people will have them in their portfolios, and if the share price falls, as they did in recent weeks, not a bad time to buy them. All right, so let's now go to Australia. Are the big companies that have done unbelievably well over the last year, the easiest one to point out is CBA, all right? I don't think. Do you hold CBA?
Well, I actually have a little bit of CBA in my portfolio, because if you look across the banks is a big part of the index.
Important,
and I hold the high quality ones. Then the the ANZ, which is probably struggling.
But would fund managers like you or others that maybe not as adventurous as you are think to themselves, CBA's done fantastic well. I've made a lot of money here. Why wouldn't I take a bit of profit? On the supposition, it'll probably fall to 110 or 115 and won't stay at 136 or whatever. Do you think a lot of people are thinking that? If so, where do you think their money's going?
Look, I absolutely think people is doing that, but as the share price rally higher, people continue to do so. I think if you look at the investors, you can see started some value hunting across the cyclical company you talk to that's leveraged to lower interest rate, and also the resources company. We start seeing a little bit buying, but look, people still waiting to see a bit more evidence.
Well, that's why I wanted to. I'm trying to corral you into where I want you to be, because in a sense, the US boom was all tech stocks. Here is like nearly top 20 stocks have done well, apart from the miners and probably energy. Now, do you think, China's going to be a stronger economy in 2025, and that's going to help the miners, which look like they're at good value at the moment? BHP around $40.
Absolutely. I think, China is recovering just very, very slow compared to what previously expected, but they're still growing for a big economy. BHP at the moment is trading on such a low PE, given its exposure to a lot of future-facing metals that we've been talking about previously, the copper and others. And I think iron ore price itself is actually holding there pretty well. So I think it looks incredibly valuable.
So therefore, the fact that I'm telling my clients it's okay to sell a little bit of CBA to buy a bit of BHP at this point in time, not a bad idea.
Oh, not at all. I would agree. That's what I'm doing. I think that's it's very sensible, and BHP is going to pay quite a nice dividend as well. And then the share price is actually pretty cheap if you look at where the commodity prices are. So come earnings season, you have a big dividend and then a very cheap valuation, and then improvement in any part from China. I think its share price is heading higher.
So what I wrote for the Switzer report today was, if big tech in the US is going to be under a little bit of pressure. And as I say, I think even if it comes back, the falls, they'll still buy on the dip in a sense, but not expecting to make the same booming profits they've made over the last 2 years. But given that, then, what happens to our tech stocks, like wonderful companies like Xero and NextDC, which I see them being more like blue chip tech stocks, and pretty good companies like Ordinate and Megaport. I know all the analysts like them, but what about you? What do you think
Oh,
about
I like
this?
them too. I actually think it's every portfolio needs to have quality growth companies because for your portfolio to inch forward, look forward 5 years, you've got to future proof your portfolio. It's got to grow.
Yeah.
Just dividend is not enough. You've got to have everything. And then with the growth buckets, some of our tech company, Life 360, Zero's done incredibly well. Next DC, I think data center is the way to go. And recently they announced some contract that's coming through. The result we know will be quite reasonable, and then apparently there's another really large contract in the pipeline. So there's just so much demand for those assets. I do think that you should have them in your portfolio.
But you've mentioned the really good ones, but what about the ones who I think are good companies, but they're not regarded as blue chip tech stocks like Zero and NextDC? What about Ordinate and Megaport? What do you think about those?
Look, I like Megaport and I like Ordinary as well. Megaport, I think, heading into the result itself, I think more or less in line. I think chance for them to disappoint is, given where the share price is, I actually think it's probably more upside than the downside. I think get caught in that whole small cap wasn't, interesting, and, everyone sort of piled into other, more interesting companies. So I think come result time, there's actually upside to the result. And I do like it. I think it does plays into that whole, the cloud and then the AI movement as well. Ordinary, I really like the share price of recent was come down. I've always
23 to 8.
That's right. I really watch this. I always watch this one from afar because it always just looked a little bit expensive, but incredible company. So I think it looks very, very interesting.
I noticed that the UBS analysts said something that I really like. He said, and they were objective about the last report, and they have reduced their target, but from $8 they're still looking at like $10.50 or $12 or whatever. So it's a nice rise even if it happens. But the words I like that what they use is that they've got a deep moat. Now that's a wide moat's good, a deep moat's good as well, I presume. But when a company's got a moat, it means that it doesn't really have many competitors out there, which I think is a good sign for a company going forward.
I really think so. This company have benefited a lot coming out of the COVID events and the like, and now they're cycling a bit of tough comp, and obviously management disappointed, somewhat. So it would just take a little bit of time for a company to find its footing. But in terms of the product, it's quite incredible.
Yeah, I think so too. So that's my, and that's what I've bought too, by the way. Not much, but I think that you're a nice speculator add to the portfolio. But what have you liked and bought over the last week?
Look, in the last week, we bought a lot, to be honest. On Monday, we bought a lot of, Life 360 because we know heading into result. Clearly, they had a great result. And we still think there's more to go. We bought some discretionary because JB Hi-Fi was looking pretty cheap to us. And we were thinking potentially special dividend and the like. And today all came through. And the trading update, incredibly strong.
It's unbelievable, isn't
It's unbelievable. For a company that trades so strong and against our odds, right, it still continue to deliver outperformance to expectations.
Do you think because, and I know other retail department stores like Harvey Norman and Bingley sell these sorts of products, but do you think JB Hi-Fi captures all the people who want to do tech and buy tech? Not all, but a lot of the young people in particular would be more likely to go to a JB Hi-Fi than the other department stores.
Absolutely, and I think JB Hi-Fi management team just gets it, gets what people want to see, like the warehouse look and the thing, pricing, discount, all that. So I think they just get it, and they just done it very, very well.
Yeah, that's great stuff. Thanks for joining us, June Bailey.
Thank you for having me.
See you in a couple of weeks' time.
Good luck.
And that was June Bailey of Tribeca Alpha Plus. Coming up now is Jason Tay of the Switzer Dividend Growth Fund. Thanks for joining us, mate.
Thank you for having me.
How did you react to last week's sell-off of the market? Was it something you were anticipating that one jobs report could bring forth ideas of recession and a big sell-off?
Yeah, look, I mean, it's amazing how fast the market has moved, right? It just seems like a straw has broken the camel's back. It was a weak jobs report at first, and then you had the Bank of Japan raising rates unexpectedly, which pretty much led to an unwind across Asia for all risk assets. And the volatility we witnessed, we certainly haven't seen that for a while.
And so, what do you think? How did that affect the way you run your fund?
I think, look, nothing's really changed the way we manage money. You know, we try to control the risk profile of the portfolio so that, whenever there is an unexpected shock, and not that we have a crystal ball on these unexpected shocks, but when they do come across, the portfolio always remains resilient in the face of these uncertainties.
Yeah, but did you say, you little beauty, I'm going to buy this because these idiots are selling off companies that I want to hold in?
Yeah, I mean, look, unfortunately, the market didn't come off that much, right? So it did come off.
But bounced back.
Yeah. I mean, it hasn't sort of bounced back to where it was before. But, look, I always sort of look at volatility as opportunities to actually reload in some good quality companies. But you just need the valuation premium in some of these stocks to come off a lot more before they can generate sustainable returns.
So in many ways, you would have preferred a more sustained sell-off ahead of an ultimate bounce back, but giving you a window to buy more of the companies you want.
Yeah, who would have thought corrections would have just been less than a week?
Well, okay, so where does that leave you? Like, my view has always been it's likely that the US market will have another leg up based on rate cuts. And then ultimately rate cuts will help us as well sometime down the track. So I'm not worried about 2025, though I might become more defensive sometime in 2025. From what you've seen now, has anything changed from your point of view?
Yeah, look, I think when you monitor how the market has reacted, right? So previously, bad news was good news.
Yeah.
So slowing economic growth, which would lead to the Fed cutting rates, was considered good news, which is why the share market always rejoiced. What the last couple of weeks have shown was that, bad news might become bad news, right? Because there's a fine line between that economic slowdown and the potential for a recession. Right?
It's soft landing versus hard landing recession.
That's right. Yeah. So that's the key question in terms of what the market's trying to grapple with, right? And time will tell over the next few months with potentially more softening data in the US in terms of how the market will react to that. Because if the markets do sell off based on I guess unexpected further slowdown in economic stats, then you could create more volatility.
So we're in the hands of data. If the data shows soft landing was a wise view to take, and they cut interest rates. By the way, if the Fed cuts by 25 basis points, will that be seen as they're not worried, or will it be seen as them being typical central banks, too scared to cut by 50 basis points?
Oh, good question, actually.
That's what we do over here.
Yeah,
good questions,
Good question. Yeah, look, I don't sort of analyse the minutiae in terms of what the Fed's going to do.
Yeah, because people don't ask you like they ask me questions all the time.
Yeah, that's right. But look, I mean, I think the market expectation is 450.
Yeah.
If they do 25, that will catch the market off by surprise.
Yeah.
Right? And the question is, if we do get further weakening economic stats, the market could come off because maybe the market will be saying it's not enough. Yeah. Right? So, but we'll have to.
I guess in many ways, if they give 50 basis points and the data remains okay, well, they don't have to give the second one until a few months later.
Potentially, yeah. And you could sort of see what the market's trying to do, right? So look, 2 weeks ago we had soft numbers. And then just recently we had a slight improvement in the initial unemployment claims, right? Which is a data point.
Which is often ignorable, isn't it?
But, but 1 week data, and the market, breathed a sigh of relief, and the market recovered off the back of that. So that's a good news story as opposed to bad news.
Okay, BHP at $40. Does that become attractive for a fund manager like you?
Yeah, so like miners are always difficult, right? From the point of view, unless you want to take a contrarian trade.
Yep.
Now, BHP share price has been weak, and it's weak because the iron ore price has been weak, right? Albeit the iron ore price is still elevated versus
better than what Treasury ever expected.
Yes, absolutely, right.
Lower.
Versus the $70 budget that most people have. But look, iron ore price is around $100, so BHP is still minting it from a cash flow perspective. a view on BHP today is really a view on iron ore, as you would expect, right? As we know, China is not stimulating in a big way. They're stimulating a little bit, kind of like data dependent in a way. They're not rushing like they have historically before when they stimulate the economy. And because of the small stimulus programs, you're not seeing a mad rush to buy iron ore stocks, right? So it look most likely will probably trade sideways because I think the Chinese government will probably do just enough just to keep the economy alive, but won't do more as what we.
So you're not rushing into miners at this point in time?
The portfolio has BHP, but I'm not topping up.
Yeah. Okay. So what are you topping up?
So look, the portfolio, like I said, it's already positioned defensively. You know, the biggest stocks in the portfolio is Amcor. That didn't come off in the sell-off. Other stocks that's reasonably large positions in the portfolio is Steadfast, which is an insurance broker.
Yeah.
Obviously, strengthening insurance premiums is good for Steadfast. So again, that's a pretty defensive, resilient business.
Yep.
And Fisher and Paykel Healthcare, another defensive, resilient business that really hasn't come off.
What is your best income payer in the portfolio?
Ooh, look, it from a dividend perspective, it would have to be the miners, right? Now,
because they're historically very high, aren't they?
Historically very high.
Yeah.
Their multiples, unlike in most of the industrial stocks, they aren't as stretched. So hence, low multiples mean higher dividend yields. Obviously, the $1 million question is how sustainable is the commodity price. But assuming that they are sustainable, then the yields are pretty healthy at current levels.
Okay. So is there any new company on your radar screen that either you've added recently or you're waiting for the right opportunity to buy?
Yeah, look, a couple of new stocks that has been added to the portfolio recently, and it's really more to do with increasing the exposure to gold, right? So right now, in fact, the last few months we've had a pretty decent position in Newmont, the world's largest gold company. Newmont is listed here in Australia because they bought out Newcrest,
Yep.
right? So we didn't want to buy more of Newmont, because we have a concentrated position already.
Yeah.
So we just want to diversify the bets to other gold stocks. So we have smaller positions now in brand new stocks in Northern Star and Evolution.
Yeah, two very good companies.
Yeah, so they're both companies have done Australian-made companies have done reasonably well. And sorry, by the way, here's another anecdote. The CEO of Newmont is Australian as well.
Oh.
So they're all Australian.
Yeah. Well, we're pretty good at collecting gold, as we've shown over the last 2 weeks.
Yeah.
Jason, on that subject, gold prices are at historic highs.
Yes.
Is the thinking that historically, when the US cuts interest rates, people start chasing gold?
That's right. Yeah. So typically, gold performs well when rates are cut.
Yeah.
Right, because there's and when rates are cut, typically there's some sort of level of uncertainty associated with the economy.
Yeah.
Soft landing, hard landing, who really knows? Yeah. But there's a flight to safety towards
recession. Is recession good for gold too?
Gold will typically perform well, but depending on how hard that recession is, because in these hard recessions, you always get these liquidity events that affects all stocks, right? But we'll have to sort of wait and see.
Yeah, I know, because there have been times when I foolishly was prepared to share my views on Twitter, which of course is now called X. Laughed away. I always said X, formerly Twitter. I don't know. I think we all know that by now. Anyway, but I used to share my view, tell them what I was writing about. And there was a whole bunch of gold lovers when gold prices were really low, who always hated it if I said, no, we're not heading for inflation. Whenever I wrote a story using my economic credentials as a former academic, saying it's highly unlikely that the doomsday merchants are going to be right, they hated it, and they and they called me a stooge of the banking system and all that sort of stuff. So I know gold people are very, very reactive.
Yes, yeah. You get a certain group of individuals that are very loyal to that commodity.
Yeah, they're called gold bugs.
Gold bugs, yeah, that's
and they
right.
bugged me, I can tell you that. All right, is there anything else you would share with us that you've learned over the last week or two that's influencing the way you're going to invest?
No, I think the portfolio is, it's rock solid as it is. 30% of the market volatility has been removed from the portfolio, so it will provide a cushion if we do see more volatility. And I'm just waiting for better opportunities. I want more of a bigger market sell-off to actually buy high-quality companies at good prices.
Okay. Justin Tate, thanks for joining us.
Great, thank you.
And that's the show for this week. Thanks for joining us. Don't forget, for subscribers to the Switzer Report, you can check out Boom, Doom, Zoom on Thursday. It's our webinar where you get a chance to ask questions about the stocks you might be interested in buying. Thanks for joining us. See you next week.